Good morning and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Tuesday, or excuse me, it is not Tuesday. I wish it was Tuesday, but it's Thursday. It's Thursday, April 2nd, 2020, and we are pre-recording this Trading Places Live. Currently, futures are pointing to a strong open, but we know how things can change quickly in this environment. Well, let's go ahead and just talk about the agenda first. We got the daily market report up first, like we always do. Like to start off, see what happened yesterday. Going to go through talking technically. Again, want to just focus on the S&P 500. Maybe take a trip down memory lane, compare it to what was going on back in 2008. We've been doing that a lot, but I think it's a good reminder every day because we are seeing a lot of volatility in the market, big jumps back and forth. So we'll go through a little bit of that again today. I do want to give you a little sample of what I'm going to be doing tomorrow over at Earnings Beats. So I'm going to just say that I'm going to give you a little sample of our war room that I'll be talking about in just a minute. We got a couple of earnings reports out there, so go through Earnings Spotlight, see how what kind of reaction we're getting from a couple of earnings reports. I think this is going to be a very interesting earnings season, because a lot of folks are going to be reporting not so bad numbers, probably pretty good numbers from the last quarter. But what are they saying about the next quarter? Because the stock market at this point, I think, is only concerned about what's going on ahead. So as we get into earnings season, and we're only a couple of weeks away from this really picking up, I think we're going to have what could be one of the more interesting earnings seasons ever. Upgrades, downgrades, got a few of those. I'll share a couple, and then we'll wrap up the show with the 3 you must see. That's where I like to give you 3 charts to think about going into the trading day, some things that maybe piqued my curiosity, and I'll share those with you at the end of the show. But before I get into all of that, before I get into the daily market report, I do want to just point you to earningsbeats.com, because tomorrow at 10 a.m. Eastern, we're going to have a special war room. It's really just a webinar room, but take the W and the AR from the webinar, you got war. Just a little play on words. But what I want to do is, with all the social distancing going on, a lot of folks working from home, a lot of folks maybe already home, maybe you're retired and can't go anywhere. So kind of feel like this would be a good time. I normally do these shows, or I do these shows Monday through Thursday for a half hour. And so I want to take some more time tomorrow and spend a little bit more time with the Earnings Beats community and show a little bit about how all of this is changing, not only the types of stocks I look at, but also how I'm trading this market. When we get into a really fearful market like the one we've been in, with a volatility index, up in the 50s, 60s, 70s, 80s, that is a completely different environment than trading when the VIX is down around 10 or 12. And if you try to treat it the same, and you just take that same trading strategy in this kind of an environment, you can get absolutely crushed. So you really want to be careful. It's changing the landscape of which stocks you want to own, which areas of the market you want to be in, but it's also changing the timing, how long you want to own these stocks. And I'm speaking to traders right now. Again, long-term investors, you stay the course. There's going to be a lot of opportunities coming out of this. The market will rebound. It always does. If you go back in history, yes, these are painful times when we get the market falling like it's been falling, but we will recover. So I just want to spend some time. I have no idea how long it's going to be. It might be an hour, might be an hour and a half. Come in for as long as you want. It's going to be recorded. But if you want to be part of that, at earningsbeats.com, go in and sign up for the free Earnings Beats Digest. If you sign up for this, it's completely free. It's a 3 times a week newsletter, but tomorrow morning, we will be sending out the room link in the newsletter. So you want to at least be part of that free newsletter and part of our Earnings Beats community in order to get that. So just go to earningsbeats.com, put in your name, email address, and we'll make sure you have a link tomorrow morning for the room. And it is, at this point, I'm thinking that I'm going to plan to do this around 10 a.m. Eastern. So just after the market opens. And the whole reason for doing it then is I want to show you early in the morning how I'm trading the market, or what I'm looking for. And believe me, I'm not actively trading this market. And when I say actively, I'm not putting on 10, 15, 20 trades a day. That's just not my style, especially in this kind of an environment where you get whipsawed and you have to try to make very quick decisions. But we can look for a couple of trades that are high probability, fairly low risk in this environment. I don't think anything's low risk, but maybe fairly low risk, where we can keep our stops fairly tight and look for big reversals. And I'll show you how I'm going to do that. We'll talk about that tomorrow. And actually later in the show, we'll actually, in today's show, I'll give you a little sample of maybe something we're going to be doing tomorrow. All right, let's jump into the daily market recap. Here you can see yesterday the Dow Jones Industrial Average down 973 points. The S&P 500 down 114, NASDAQ down 339. Interestingly enough, you look at the percentages, 4.44% on the Dow, 4.41 and 4.41% on the S&P and NASDAQ. But once again, look at the mid cap and small cap. Mid cap down 5.7%, small cap over 7% down yesterday. Again, lagging mid and small cap stocks. That has been a theme, and it accelerated again yesterday. Looking at the individual sectors, consumer staples, our best group yesterday by far, down 1.7%. So all 11 sectors were down yesterday, but consumer staples, along with healthcare and technology, have been the three best areas, the three best themes throughout this move to the downside, without a doubt. And so, not surprisingly, because I do like to trade on the long side, I give our members some thoughts about shorting if that's your thing. But I still believe we're in a secular bull market. I think this obviously is a cyclical bear market, but I think when this is all said and done, we are going to rally back to new highs. I don't know how long it's going to be. Somebody would have to tell me when this virus is going to be out of our history. And then once that's gone, then I think we'll be looking at a very, very strong rebound and eventually going back to new all-time highs, which is part of a secular bull market. And if you think that that would be unprecedented to go through something like this and then go back to all-time highs, you got to go back and look at 1987. That crash was part of a secular bull market. So anyway, right now, staples, very good area of the market, I think, on a relative basis. And some of those stocks within the staples group actually look pretty good as a result of the issues that we have right now with the coronavirus. Think about a company like Clorox. Not only is a company like Clorox going to sell the things that all of us absolutely have to have, doesn't matter if we're in a bull market or bear market, we still need to do certain things, personal hygiene, things like that. Clorox is benefiting even from, not only from all of the weakness in the market, but you've got a company like Clorox that's benefiting from the increased attention to sanitation and so forth. So you really want to take a look at staples. Financials have been extremely rough. Real estate, utilities, energy, all these groups really have not been particularly good. Maybe utilities a little bit better during this move, did get above the 20-day briefly and then fell back. But yesterday, these were the four groups, and these are four groups that have struggled a lot, especially financials. Think about that 10-year treasury yield that keeps dropping. That makes it very, very difficult for a lot of financials, including banks and life insurance companies. All right, let's keep moving here. 10-year treasury yield. I want to mention while you're looking at this, let's get it up. Actually, it's not going to show just yet. Remember, we are pre-recording this today. Futures, by the way, are up. So we are looking at what appears to be, right now, futures are up about 330 points on the Dow. So it looks like we're going to get some of those points back yesterday. But as we look at the overall market and we take a look at the treasury market in particular, you can see the 10-year treasury yield. This was, kind of similar to what we were seeing on the way down. A lot of big gap downs. We gapped down yesterday on the yield, which means we gapped up in treasury prices. So again, it was fear at the open. Money goes into treasuries, money comes out of stocks at the open. But during the day, we see the TLT basically drift down, which sends the yield higher. So yesterday followed almost perfectly in that this whole theme that we've seen really over the last 6 weeks or so. We gap down on the yield, and then we finish higher on the yield. So what that means is treasury prices move lower, they gap down, treasury prices move higher, gapping up, but then sell off during the day. Treasury yields gap down and then move higher during the day. One difference, though, yesterday was after the TLT. Let me just show you the TLT. So here's the TLT. Gap up, filled candle means you close below the open. Normally, when you see this close below the open, that would represent money being sold in treasuries, and a lot of times that would translate into a decent day in stocks. But that was not the case yesterday. So not only were we selling the TLT from the start of the day, but we also were selling equities. As pull up the S&P 500, just pull up the spider, and you'll see that we gapped down, we rallied a little bit intraday early, and then we went back down toward the lows. So even though there was money coming out of treasuries, it wasn't finding its way into stocks. So that's just telling me the market's nervous. We're moving, more into cash, and I would be a little careful even with this rally this morning with futures. I think this is setting up potentially for another down move eventually, whether it's today, tomorrow, beginning of the week, whatever. Economic reports. We saw most of our economic reports yesterday weak, but better than expected. March ADP employment report yesterday came in with job losses 27,000 versus a minus 180,000 expected. So it was better than expected. March PMI came in about what was expected. March ISM manufacturing actually came in much better than expected, barely dropping from February, which was kind of surprising. February construction spending, however, and of course, again, this is February, so it's a lagging report. Yesterday was minus 1.3%. The market was expecting an increase of 0.6%, so a big miss there. This morning, the big news is initial jobless claims. Remember, last week, 3.28 million in initial jobless claims, way above the expectation. I forget where the average, the expectation was. I think 750,000 or something, which was still a really high number, but it blew it away. This week, the expectation is for 3.35 million, up from last week's 3.28 million. That's a lot of jobless claims. I don't know if we're going to come in better than that or not. We'll have to wait and see, but that is out. Actually, by the time you hear this recording, that news will already be out. Be interesting to see what futures do at that point. February factory orders will be out as well. They're expected to rise 0.2%, which would be better than January's minus 0.5%. But again, it's a lagging report back in February. I'm more concerned about March forward. So I would expect, honestly, I don't think the market will pay much attention to that February factory orders number. So some of the big news today, before we get into talking technically, some of the big news, of course, we're waiting on those jobless claims. Crude oil up almost 10% this morning to $22 a barrel. That could help to give energy stocks a little bit of a lift later today. And then the 10-year Treasury yield down those 5 basis points this morning so far to 0.59%. So once again, we're looking at the Treasury prices gapping up today and the Treasury yield moving lower. So even though the futures are higher and stocks look to rebound at the open, there's still nervousness as money is rotating into treasuries this morning. Keep that in mind. All right, let's move over to talking technically. I wanted to pull up the S&P 500. I'm going to continue to show this because I do think Fibonacci is really important during these fearful periods because extreme fear marks major levels. I mean, I know there are a lot of folks that use Fibonacci and might even use it like on little pullbacks like this. I generally only pull Fibonacci out of my toolkit when I start to see extreme fear, because I think major levels are marked, and the reaction highs are important to me to, first of all, begin to show me, is it going to be a V bottom, which normally we don't see V bottoms. And if you're not familiar with what I'm talking about, a V bottom would be a straight down and straight back up, just like in the form of a V. Normally what we see, though, is off of selling, we'll get reaction highs that will go somewhere up into this 38.2% retracement of the prior decline, or maybe as high as 50%. 2008, if we pull this up, here was 2008. This is where we had that really big decline. We were already in a downtrend, so we could go back and start the Fibonacci wherever you want. But to me, this is when the real selling kicked in. You can see that volume just absolutely went crazy at the beginning of October of 2008. And so this was the initial, you can see the rally. We never closed above that 38.2% level, but intraday we got up close to 50. And that marked a pretty significant reaction high that it took a long time to get back above. So this first move back up that we're seeing, that we have seen so far, I mean, can we go back up into this zone again? Yes, we could. Maybe this first reaction move isn't over. Maybe we just had one pullback and then a move back up. Trying to predict what the stock market is going to do when you've got the volatility index up in the 50s, 60s, 70s, and 80s, good luck. I can't tell you day to day. I can barely tell you minute to minute what the market's going to do when it's extremely fearful, because it's acting irrationally. It's not, normally what we do is we look at these charts and we say, okay, here's the 20-day moving average. It's not going to get above that. Or we look and we say, here's a gap, it's probably going to fill a gap. Maybe this gap up here on the gap down, you can see it never went back and filled. There's just a lot of things that we expect in technical analysis that we don't see when the market acts irrationally. And so as I look at this market, you might say, well, what do you mean you don't know if it's going to go up or down? I literally don't know if it's going to go up or down. What I'm watching for is to see major levels being marked. And so when I look at the S&P 500, I'm looking at this shaded area here to mark potential highs. We just about got there yesterday to the lower end of it. That could be it. I'm going to watch to see if we don't get back through that and we do begin to roll back over again. Do we hold that March 23rd low? That March 23rd low was set with extreme pessimism. That is a major support level. If you look ahead, you can see in 2008, first time we went back down into this, actually we went back down about a week later, got close to it, bounced again, came back down one more time, hit the low, and bounced, went all the way back up to the reaction high before turning back over. So as a short-term trader, the closer you get to that March 23rd low, I can't get to it at this point. There we go. So the closer we get to this March 23rd low, I think there are going to be some opportunities on the long side where we can at least keep our stops fairly close in case it breaks down. But it could break down intraday and then rally back. I mean, that's the problem with trading in a market that's this volatile, is that you think you have one thing, you nailed it, and 15 minutes later it's gone. And so that is what makes it very difficult for me to trade this market, and why I tend to take a lot of cautious steps into and out of the market. I don't go crazy with a lot of positions or trading a lot of my account balance. I just don't think that that's the right way to approach it. All right, so that was really it for talking technically. I want to move into what I'm going to call the war room. So this is just going to give you maybe a little bit of a sense of what I'm going to do tomorrow. One thing that I have done, here on StockCharts under the member tools, if you haven't used this, I think you absolutely should, the scooter reports. This is something that was developed by John Murphy, looking at large cap stocks versus large cap stocks, mid cap versus mid cap, small cap versus small cap. And it's a universe where all of these stocks within these asset classes are ranked from 99.9 down to 0.1. And so if I switch this, you'll see 0.0. So you got Apache, which right now is the lowest ranked large cap stock, meaning that relative to all the large cap stocks out there, based on the formula for the scooter, this one has the lowest score, Apache. And if you look at the chart, without even looking at the chart, you can imagine it's not going to be a very good looking chart. The stock was $25 3 or 4 weeks ago. Yesterday closed at $4. When you're losing, 85% of your market cap in 3 or 4 weeks, probably not going to be ranked very high in terms of the scooter. So that's the system that's in place. Now, if you look at some of the stocks and Regeneron, I don't know if you had a chance to take a look at the show that we did, The Pitch. Dave Keller hosted it. I joined, Mary Ellen McGonigal and Grayson Rose, and we each gave 5 stocks that we like based on everything that's happening, based on all the changing dynamics with the coronavirus, working from home, exercising at home, doing all these different things. And Regeneron is actually one of the 5 stocks I picked. And I've talked about this for months now at Earnings Beats. This was a company that was already showing relative strength versus the biotechs a few months ago. And so this was, of the 5, I think I did an article on Trading Places not that long ago where I had 5 top stocks in the biotech space that I liked. Regeneron was one of them, just based on what it was doing back then. This isn't an infectious disease company. This is a company that really looks for vaccines and things like that against infectious diseases. The Department of Health and Human Services has partnered with Regeneron to try to develop a vaccine for the coronavirus. And so now this company is getting a lot more attention because of that. And the reason I picked this stock on the show as one of my top 5 stocks is that when we go through crisis, if you think back to what happened in 2000 with the dot-com bubble bursting, and then you think back to 2008 with the financial crisis and what the financial community did after the fact to make sure that the financial crisis didn't happen again, all the regulations that went into place, everything to try to protect our banking system. Imagine when we get to the end of this coronavirus, what is going to happen in terms of making sure that we aren't unprepared for the next pandemic. We may not get another one for 100 years, but we will be ready immediately for the next pandemic. And I think a company like Regeneron is one that's going to benefit from all of that discussion and that theme, that paradigm shift in the way we think about these pandemics. So Regeneron, I gave as one of my top 5 picks. I think the stock's going to break out and continue to move higher. It closed yesterday at a 52-week high. Not too many stocks in this market right now closing at a 52-week high. So when you look at the Scooter report, if you used this report, it would have pointed you right to Regeneron Pharmaceuticals, right at the top of the list. You want to take a look at some stocks that have potential going forward, you can start right here at this list. I think you have a great group. Citrix, Norton LifeLock, Tiffany, AMD, Netflix. Think about Netflix, the theme. People are going to want to stay home. They're not going to be, can't even go out to the theater right now to watch a movie. Netflix, even though it was already a great company, more and more and more people are going to flock to companies like Netflix to be able to do things, finding entertainment at home. Another great theme. So this is kind of what, I wanted to talk about, what I am going to talk about, but I want to show you one other thing. Let's I'll pull up that Netflix chart for you. And one thing I'm looking at is accumulation distribution. You can see accumulation distribution has remained pretty close to the high on Netflix, and Netflix isn't far from breaking back out again. It's pretty amazing after the stock dropped 100 points in 2 weeks to be right back up there again. Now this is looking more like a V bottom than the overall market. So with Netflix getting back up near its high, I can tell you without even looking, the relative strength is going to be off the charts relative to the internet space and relative to the S&P 500. If you're going to trade stocks in this market environment on the long side, I want to own companies like Netflix. I want to own companies like Regeneron Pharmaceuticals. So one thing that I'm doing right now is I'm creating chart lists for each sector, and each sector that has scooters above 80. So I just showed you the scooter report. Now I'm starting to run scans. And the reason I'm doing this by sector is as I see sectors gain strength or weaken in strength, that's going to tell me whether I want to focus on some of these areas. So for instance, I can go into consumer staples and I can view all. I can put this on a summary list. I'm just going to show you because I'm going to be doing this later today in preparation for this event tomorrow. But let me look at some of the top scooters here. So for instance, Rite Aid, one of the top ranked scooters, lost 7% yesterday. That might be an opportunity. Now what I'm looking, okay, Kroger is one that I like. Actually, I talked to our members about this one. It actually went up yesterday despite the overall market going down. When you look at it at the high, when it just set the new high, the accumulation distribution was at a high. When it went back and tested its recent low, the accumulation distribution was higher. So this is one that's starting to get some attention. It's looking pretty good in terms of the accumulation distribution. It's a good relative performer. So what I'm thinking about doing is going back and setting this up in edit. And what I'll do is then take a look at Kroger. And I might go in here like this and just put in an asterisk. Now, the reason I do that is that I'm looking at the chart and I like what I see in terms of relative strength and the accumulation distribution. So that now when I pull up the summary, and if I see something that's really getting hit intraday, and I look over here and I see, oh, Kroger, this has got a good accumulation distribution, which means it tends to move up pretty well during the day, even though it may gap down. That might be a stock that I want to trade. So I'm going to identify these chart lists and try to point out. Clorox has been another one that I really like. Nice move up here. You can see we did pull back a little bit on the accumulation distribution, holding the recent low, but that was a nice surge recently. I think Clorox, especially if the market gets fearful, we may see another breakout here. All right, let's keep moving on. Got just a few minutes left. So let me go through. I want to show you one earnings report. So let's move to earnings spotlight quickly. WBA, and I'm going to first pull up the symbol summary and show you what it's doing today, because it did report. It's up 4.5%. This is one that I passed along to members a while back, although holding into earnings is a little tough. But Walgreens Boots Alliance is one that could do well in a pandemic. Think about what they do. Walgreens, drugstore. They're going to do better than most companies in an environment like this. They beat $1.52 versus $1.45. And you can see up about 4.5% pre-market today. And so that's going to take us up to, now we are seeing the accumulation distribution start to move higher, but I'll tell you, there are probably others that are better in this space. So got a little bit of a mixed signal here on WBA. CarMax also reported better than expected earnings yesterday after the bell. PVH reported better than expected earnings. Let's go upgrades, downgrades. I'm just going to give you a couple of these. We'll take a look maybe at one. I'm going to let's pull up Disney. Disney was upgraded and downgraded today. Now, on a accumulation distribution, it's actually starting to strengthen quite a bit. I'd be watching this. If Disney could get through 105, 106, I think that would be a really solid move technically. And watch these lows, these reaction lows. Disney down close to those lows might present an opportunity here. Some other upgrades, BMY, DHI, PCAR. Downgrades, Applied Materials, AMAT. Danaher, DHR, Lyft downgraded along with Toll Brothers. And as I mentioned, Disney both upgraded and downgraded. All right, let's move on to the three you must see. And what I did is I went into energy using the Scooter report, and I pulled out the three top small cap energy plays, or I think three of the four. There was one I didn't like. But ENPH, Enphase, just recently up near a high in terms of both price and accumulation distribution. And as we come way down below the low that we saw at the end of February, we actually are holding up in the accumulation distribution. This low here versus this low over here, the accumulation distribution is much higher. So I think this one's looking pretty good. Let's see. Next up is Plug. This is Plug Power. Another one. Look at the accumulation distribution setting a new high at this hot price high, which was way below this prior price high. And as you're moving down with these lows, see the low at the end of February and the low mid-March, lower lows clearly, higher accumulation distribution. So yes, price action's going down. If you owned it and you looked in your account, you'd be losing money. But underneath the surface, I actually think these are pretty positive signals. So as the stock pulls back, I want to watch this. But if it continues to hold up, gets close to price support, and that accumulation distribution is still high, might be one to take a shot with, maybe consider anyway. And then we're going to wrap up today with the final three you must see, and that is the top rated small cap energy play right now, Fuel Cell Energy. It's a small company trading at $1.39. This is not normally a stock that I would trade, but I wanted to just show you because as we have been moving lower, you can see accumulation distribution up near its high. When you look at the volume the last few weeks, when we've had spikes, we've seen the price go up. When we've had light volume, we've seen it come back down. So when it comes down light volume, it's been providing some pretty nice opportunities, something to think about. All right, I hope you can join me tomorrow. Again, go over to earningsbeats.com, sign up for the free newsletter. We'll give you the room instructions tomorrow morning. Hope you can join me in our war room. Everybody have a great day. See you next week here on StockCharts TV. Happy trading, everybody.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.